In this and the next few sessions, we will look at how interest rate derivatives are used both by firms and financial institutions alike to hedge against interest rate risks. A derivative, as you might already be aware, is an asset that derives or takes its origin from another asset. Most commonly used derivative instruments to hedge against interest rate risks are interest rate futures and interest rate swaps. We will first look at interest rate futures. Interest rates futures contracts are legally binding agreements to buy or to sell a standard quantity of a specified financial asset such as treasury bills or government securities at a specified price. The contract also specifies the settlement date, that is, the date on which cash and the underlying financial assets are delivered or exchanged between the counterparties. All futures transactions, and interest rate futures are no exception, are bought and sold through a futures exchange. Hence, trading is absolutely anonymous. That means the identity of the counterparties, the buyer and the seller in that transaction, are not known to each other. Furthermore, settling these transactions is guaranteed by the futures exchange. As a net result, price discovery is very transparent. In just a few minutes from now, we will discuss the mechanics of how interest rate futures are bought and sold in the futures exchange by firms and financial institutions with the specific objective of hedging against or profiting from fluctuations in interest rates. But first, we will look at the structure of the interest rate futures market. Like in any futures market, interest rate futures markets also have broadly two types of participants: hedgers, who wish to eliminate any risk or potential losses arising from fluctuations in interest rates. Do bear in mind, interest rate risk is embedded virtually in all interest-bearing financial assets such as corporate bonds, commercial loans, etc., owned by the hedging entity, as reflected in its balance sheet. The second type of participant in the interest rate futures market are speculators, who participate in the interest rate futures market merely to make a profit by taking a position based on their view on the likely movements in interest rates in the foreseeable future. As you would have already guessed by now, speculators effectively take on the risk that the hedgers want to get rid of, and hence both hedgers and speculators are necessary almost in equal numbers for the efficient functioning of the interest rate futures market. Interest rate futures markets in major financial centers around the world are limited to currencies that are extensively used in global financial transactions, such as the US dollar, the pound sterling, the euro, etc. But you would also find futures markets for a specific currency in its country of domicile, such as the Korean won in South Korea, Indian rupee in India, etc. With a view to ensure that risks embedded in futures transactions do not devolve on the futures exchange where the transaction is executed, all open positions held by participants in the futures exchange are governed by margining mechanisms as mandated by the futures exchange. Participants, both hedgers and speculators in that exchange, will be required to adhere to these margining requirements. The mechanics of how margins are calculated and maintained by the exchange is explained in a document provided at the end of this video.